What if I told you that there's a way to make or lose thousands of dollars in just a few hours on the stock market? No, it's not crypto, it's not penny stocks. It's something Wall Street professionals and aggressive retail traders are using every single day. It's called Zero DTE options, and for some traders, it's the ultimate high-risk gamble, while for others, it's the smartest short-term strategy in the market. But which one is it really? Zero DTE stands for 0 days to expiration. That means you're trading options contracts that expire the very same day you buy them. No weeks, no months, no time cushion. You wake up in the morning, place the trade, and by 4 p.m. Eastern Time, it's either worth something or it's worthless. Completely gone. That's the brutal simplicity of it. To understand why Zero DTE options are so explosive, we need to quickly break down how options work. An option is a contract that gives you the right, but not the obligation, to buy or sell a stock or index at a specific price before a certain date. There are calls, which bet the price will go up, and puts, which bet the price will go down. Normally, traders buy options that expire weeks or months in the future. That gives the stock time to move in their favor. But with Zero DTE, you don't have time. You're betting on what will happen today, and that changes everything. Because options lose value as they approach expiration, this is called time decay, and it accelerates rapidly on the final day. On Zero DTE contracts, time decay is not a slow leak, it's a waterfall. Every minute that passes eats away at the premium. If the underlying stock or index doesn't move quickly in your direction, the option's value can collapse in hours, sometimes minutes. But here's where it gets interesting. That same rapid decay that destroys slow traders creates massive opportunity for precise ones. Since these contracts are so short-lived, they're extremely sensitive to price movement. A small move in something like the S&P 500 or NASDAQ can cause Zero DTE options to spike dramatically in value. A 1% move in the index could turn a small premium into a multi-100% gain if you're positioned correctly. This is why Zero DTE trading has exploded in popularity, especially on index ETFs like SPY and QQQ. Every single trading day, new contracts are listed that expire that afternoon. That means traders don't have to wait for weekly expirations anymore. They can make fresh bets daily. And because these are index products, they're highly liquid, meaning there are tight spreads and plenty of volume. But don't confuse accessibility with safety. The reason Zero DTE options can generate 200% gains in a few hours is the exact same reason they can drop 100% just as fast. There's no recovery time. If you buy a call in the morning and the market moves slightly against you, time decay compounds the loss. Even if the market later reverses, your option may already be too damaged to recover. It's not like owning stock where you can wait days or weeks. By the closing bell, it's over. And that psychological pressure changes the way people trade. Decisions must be fast. Emotions run high. Traders stare at charts tick by tick, watching every candle form. It becomes less about long-term investing and more about intraday precision. You're not betting on where the market will be next month. You're betting on where it will be in the next hour. Now, here's something most beginners don't realize. Zero DTE options are not inherently reckless. They're simply tools. In fact, many institutional traders use them strategically to hedge risk or capture short bursts of volatility around events like Federal Reserve announcements, inflation reports, or major earnings releases. On high volatility days, these contracts can provide targeted exposure without tying up large amounts of capital. But for retail traders, the danger often lies in misunderstanding probability. Out-of-the-money Zero DTE options are cheap for a reason. They require a significant move in a very short time. Buying them repeatedly without a structured strategy is statistically similar to buying lottery tickets. The wins feel incredible. The losses are frequent and quiet. So are Zero DTE options a high-risk gamble, or are they a smart play for disciplined traders who understand volatility, timing, and risk management? The answer isn't simple, because it depends less on the instrument and more on the trader using it. To really understand whether Zero DTE options are a smart play or a fast track to blowing up your account, you have to look at the mechanics behind the scenes, specifically volatility, gamma, and positioning. These aren't just technical buzzwords, they're the forces that determine whether your trade explodes in profit or evaporates before lunch. On expiration day, options experience extremely high gamma. Gamma measures how quickly an option's delta, its sensitivity to price movement, changes as the underlying asset moves. In simple terms, on Zero DTE contracts, small price movements can dramatically change how reactive the option becomes. If the market starts moving strongly in your direction, your contract can accelerate in value much faster than a longer-dated option would. That's the rocket fuel effect traders love. But gamma cuts two ways. If price moves slightly against you, the contract can rapidly lose sensitivity, and combined with aggressive time decay, it becomes a double hit. This is why Zero DTE trading is often described as trading pure volatility. You're not just predicting direction, you're predicting speed. If the move is too slow, even if you're technically right about direction, you can still lose money. Another major factor is implied volatility. On big event days like CPI inflation releases, jobs reports, or Federal Reserve rate decisions, implied volatility can spike early in the day. Traders pile into Zero DTE contracts expecting a major move, but if the actual move is smaller than expected, volatility collapses. That collapse, known as implied volatility crush, can destroy option premiums even if price doesn't move much at all. So you're fighting both time decay and volatility shifts at the same time. Now let's talk about why Zero DTE has grown so popular in recent years. Exchanges began listing daily expirations on major index products like SPY and QQQ. Every single trading day, new contracts are listed that expire that afternoon. That means traders don't have to wait for weekly expirations anymore. They can make fresh bets daily. And because these are index products, they're highly liquid, meaning there are tight spreads and plenty of volume. But let's bring this back to the individual trader. Most retail traders approach Zero DTE with one of two mindsets. The first is the lottery mindset. They buy far out of the money calls or puts for very cheap premiums, hoping for a massive breakout. Occasionally, this works, and social media amplifies those wins. Screenshots of 1,000% returns spread quickly. What you don't see are the dozens of expired contracts that quietly went to zero beforehand. The second mindset is the structured trader. This trader focuses on defined setups, key support and resistance levels, opening range breakouts, trend continuation patterns, or volatility squeezes. They size positions small relative to their account. They use strict stop losses. They may even sell premium instead of buying it, taking advantage of time decay rather than fighting it. For them, Zero DTE is not about gambling, it's about precision and risk control. Here's the uncomfortable truth. Zero DTE magnifies your weaknesses. If you lack discipline, it punishes you quickly. If you overtrade, losses compound fast. If you chase momentum without a plan, time decay becomes your enemy. But if you understand structure, probability, and risk management, it becomes a tool, not a threat. There's also a capital efficiency argument. Because these contracts are cheap compared to buying 100 shares of a high-priced ETF, traders can control significant exposure with relatively small amounts of money. For someone with limited capital, this leverage is attractive, but leverage is neutral. It amplifies both intelligence and mistakes. So are Zero DTE options high risk? Absolutely. They compress weeks of option dynamics into hours. They demand focus, speed, and emotional control. But are they automatically reckless? Not necessarily. In the hands of a disciplined trader with a tested strategy and strict risk management, they can be used strategically, especially in high volatility environments. The real question isn't whether Zero DTE is dangerous. The real question is whether you're prepared for the speed, pressure, and discipline it requires. Because in this game, there is no wait and see. There is only today. And by the closing bell, the verdict is final.
Let's get practical and break down exactly how traders approach Zero DTE in the real world. Most successful traders start with a plan that combines timing, direction, and risk control. First, timing is critical. The best opportunities often appear in the first hour after the market opens, or in the last hour before the close. Why? Because these periods are when volatility and trading volumes spike. Morning gaps, unexpected news, or large institutional flows can create rapid movements, exactly what zero DTE options thrive on. Conversely, midday tends to be quieter, and holding contracts then can feel like watching your money evaporate while nothing happens. Next comes direction. Predicting where the market will move, even for a few hours, is essential. Traders use technical analysis like support and resistance levels, moving averages, and intraday momentum indicators to gauge short-term trends. Some even combine these with macro catalysts like economic data releases or corporate news to anticipate spikes. Remember, with zero DTE, even a 1% move in the underlying asset can translate into massive gains or losses. That's why precision isn't optional, it's mandatory. Risk control is the third pillar. Even experienced traders treat each zero DTE trade as a micro-investment. Position sizing is carefully calculated, rarely more than 1 to 2% of total account capital per trade. Stop losses or predefined exit points are strictly adhered to. Some traders use spreads, buying and selling options simultaneously to limit risk while still gaining exposure to potential volatility. Others sell premium to take advantage of rapid time decay, effectively flipping the usual risk profile. They're not hoping for a big move, they're profiting if the market stays steady or moves slightly. It's also worth noting the psychological aspect. Zero DTE trading is not for the faint of heart. Watching contracts shrink towards zero with every passing minute can trigger stress, impatience, or impulsive decisions. Traders need emotional discipline as much as technical skill. Many will set alerts, predefine exit rules, and even step away from the screen for short periods to avoid panic trades. Another point often overlooked is the effect of repeated exposure. A single zero DTE trade can be thrilling or painful, but consistent, repeated engagement without a structured approach can drain both capital and confidence. The difference between a reckless gambler and a professional intraday trader is consistency, understanding probability, respecting risk limits, and avoiding emotional trades, even under extreme pressure. Finally, there's the broader strategy angle. Some traders use zero DTE options not to speculate wildly, but as hedging tools. For example, if a trader holds a long stock position, they might buy same-day put options to protect against sudden market drops. This allows for precise, short-term insurance without tying up large amounts of capital in long-term hedges. In other words, zero DTE can be a weapon in the risk management arsenal, not just a high-stakes bet. So, what's the final takeaway? Zero DTE options sit at the extreme end of the risk spectrum. They're fast, volatile, and unforgiving. But in the right hands, with the right preparation, they can be incredibly powerful. They reward speed, precision, and discipline, and punish indecision, overconfidence, and emotional trading. In essence, they magnify whatever trader psychology you bring to the table. In the end, whether zero DTE options are a high-risk gamble or a smart play comes down to one question. Are you prepared to trade at lightning speed with calculated risk, or are you chasing excitement and hoping for a miracle? Because in zero DTE trading, the market doesn't wait, and neither should you. But only if you know exactly what you're doing.